Okay, so thank you very much for joining the session, and inshallah, we will be starting with chapter 2 today, which talks about different tax regimes. Uh, in the previous session, we talked about the orientation and we discussed a number of fundamental central concepts which were defined in Article 1 of the UAE Corporate
Hmm.
Tax Decree Law, right? So, do you have any
Correct.
questions, if I may ask, like regarding the previous session in which we discussed about the central concepts, etc.?
Uh, Not really. Whatever the questions I had, I asked you at the same time
Very good.
because those are the questions which I had when you were actually explaining me the concepts. I just want to know whatever the points which I wanted to ask you. I asked you everything.
Okay, very good. So yeah, this is what I it would go to your benefit itself if you ask me right there and then. That's the whole point of having a marathon session. And more importantly, are you aware that this recording I uploaded also on the YouTube, so you'll have that. So anyways, we will today talk about the regimes. Um, Generally speaking, there are three rate regimes in UAE. You know what is the meaning of the word regime? Do you?
No,
Regime is
no.
like program. Okay, like the set of rules that is followed. Okay, that's the this is called regime. So you're going to hear this word regime in matters of taxation quite a lot. Okay, different, for example, you'll hear in UAE we have a qualifying free zone person regime or a top up tax regime, or under the SBR regime, small business relief regime. So regime is basically a kind of a program, a kind of a system in which rules, specific rules apply. Okay, so generally in UAE, the rate related regimes or the programs or the kind of propositions are three. First of all, we have a regime which is called the standard tax regime. Okay, this is Article 3. If you look at the original format of the decree law that was issued by the federal president, that was approved by the president, the federal decree or the mother law. In there, the Article 3 talks about different taxes. So it's probably everybody knows it. Until 375,000 dirhams, there is 0% taxation, right? And above that,
Yeah.
9%. Everybody knows about this, right? But
Yeah.
the
Yeah.
interesting part is that this threshold of up to 375,000 dirhams, 0%, and above that 9%, it was not written directly inside the federal decree law. This came by way of a cabinet decision number 116. Okay, so in that cabinet decision, the this 375K or 9%, etc., all of that was clarified in the cabinet decision. Okay, so a very easy to understand example, I think you might already, you would be able to solve quickly. Uh, for example, there's a John, an employee who has 480,000 dirhams salary income, 3.1 million from return on his personal investments, and then 4.2 million of taxable profits, uh, referred to his taxable income of 1.375 million, 1,375,000 dirhams during 2025. What is the tax? What is the corporate tax liability? So what will happen? 480K, which is salary, it is out of scope of corporate tax law, right? That it will be,
Yeah.
we'll ignore that. We will also ignore his 3.1 million dirham worth of personal investment income, return on investment and real estate. This is also considered as passive income. This is not also part of the or within the scope of the corporate tax laws. That will also be ignored. But he has a freelancer license, which has a revenue of 4.2 million, that amount, if it is freelancer license, that will be considered as and
Taxable.
this was the revenue. But on this revenue, actually the net profit in this, there was only 1 million
1.3. Yeah.
775. So this is taxable. Out of that, the first 375K zero rated, remaining 9%. That means his liability becomes 90,000.
90,000.
Yeah. So that's how we calculate it. Now, in Saudi Arabia, we have, instead of this 0% and 9%, Saudi Arabia has a 20% uh, tax rate, corporate tax rate. So and their taxation happens um on a resident capital company, a non-Saudi resident natural person who conducts business. So natural person also, by the way, that is also part of the Saudi tax regime. And what else do we have? There, a non-resident person who conducts business in the kingdom through a permanent establishment. Now, focus on the point that they identified a non-resident person. It could be juridical, it could be natural, who conducts business in Saudi Arabia through a permanent establishment. Have you heard the word permanent establishment before? Have you heard the word permanent establishment before, Rafi? You're mute, Rafi. Hello.
I'm sorry, sir. I'm sorry.
Ah,
Yes,
okay.
yes, of course, yes. Permanent establishment is a place where a fixed place of business.
Hmm. Okay, correct. So it's a fixed place, but is it usually said in the context of a non-resident person or a resident person?
Resident person by default,
Permanent
I mean,
establishment by default usually
mhm,
is referred in context of a non-resident person.
non-resident.
Okay, if it is a resident person, then probably the permanent establishment word will not even come here. The whole idea of permanent establishment, as you rightly pointed out, was that it is usually a fixed place of business of someone who's actually outside the country, a company which is incorporated in another country. They may have a permanent place of business in a particular country. So that's why the word permanent establishment. The tax rate of the tax base for a taxpayer engaged only in natural gas investment activities will be 20%. So if someone who's into natural gas investment activity, again, that person will be subject to 20% tax rate. But the interesting rate is on oil and hydrocarbons. Tax rate for the tax base of a taxpayer engaged in the production of oil and hydrocarbon shall be 85%. It is different from UAE. Why? Because the oil and hydrocarbon related sale purchase, the direct taxation of it happens at emirate level in UAE. It doesn't. It is not covered in the federal decree law. It is exempted actually. We will see that soon when we reach the chapter of exemption. Okay. The, hydrocarbons in UAE, they are not covered. In Saudi Arabia, however, they are still part of the federal royal decree law. Now, one more interesting point is that withholding taxes are those which are specified in Article 68 of that law, of the federal law of Saudi Arabia, royal decree of the Saudi Arabia regarding the income taxes. Article 68 talks about and there is withholding tax in Saudi Arabia, which is other than 0%. There are certain 5%, 10%, whatever it is. Different rates are identified.
Depends on
But
the countries.
depends on the countries, etc., and yeah, and the type of transaction also. But it's a very interesting question about UAE. Are you aware about UAE's withholding tax? Any idea? Withholding tax
Yeah,
regime?
yes, UAE do not have withholding taxes yet.
Yeah, that is why I asked you this question. So when we reach there, I think Article 45 or something, or 49. We'll see that. But this answer is actually not right. What you said was that UAE does not have withholding tax, right? That's not the right answer. UAE does have withholding tax, but the only point is that as of today, until today, the rate of withholding tax is 0%. There's a
Okay, when the
difference in
withholding tax rate is 0%. Okay,
there's a
got it.
difference in this, right? In
Okay,
when you
okay.
say that we don't, UAE does not have withholding tax, that means there is, there is no provision related to withholding tax.
Yeah, there is a taxes which is under 0%. All right, got it.
Yes. So it's a clever way of writing the law. You know,
Okay.
Tomorrow all they need to do is change the percentage. You see my
Mhm.
point? Instead of
Got it.
0%, they may put like 5% or 10% or whatever, 9%, whatever it is, and immediately we'll have the same provision that the rate of tax will change only. That's it. So withholding tax is there, provision is there. It's just that it is 0% as of now. Okay. The tax on a person engaged in the production of oil and hydrocarbon, in addition to investing in natural gas in the kingdom, meaning Saudi Arabia, shall be the sum of his taxes from both tax bases as per paragraph B and C of the article 7 of the Royal Decree number M1 of March 6, 2004. You see this year? That's a very interesting point. 2004. Can you imagine since what time UAE already has corporate tax? Since 2004. Actually, this is a relatively newer law. They had even before that. Okay. So,
This is for Saudi Arabia, right?
yeah, Saudi Arabia, yes. So in Oman, Oman also has a perspective. We'll update that, but right now it's not written in here. Qatar, there is the tax rate is 10% in Qatar. Okay, mainland regime is 10%. Uh, what I got aware of was that Qatar has two different tax regimes. One is in Qatar Financial Center, and then there is a mainland regime. So 10% of taxable income for the taxpayer during the tax year. Nonetheless, tax may exceptionally be rated as follows as well in Qatar. Tax rate and all other tax conditions stipulated in the agreement related to petrochemical industries as well as those related to petroleum operations. So if you look at all of that, and regarding the exploration of natural resources, etc., the tax rate shall be 35%. So if you look at these are basically natural resources and petroleum related, hydrocarbon related, 35% tax rate. Subject to provision of the agreement, a final withholding tax of 5% of the gross amount applies to royalties, interest, commission. So there is something called a final tax regime in certain countries of the world, like in even in India or even in Pakistan. There's a regime called final tax. Like it's a kind of a situation where for certain types of incomes are taxed separately. It is called separate block of income taxation. Okay, you should know that at least. You will not be confined within only the UAE tax law. You'll have some other perspectives about corporate tax as well. So in those countries, some, for example, royalty or interest or commission, they are taxed by way of a separate block of income. Do you understand what I'm saying here? Rafi, you are muted again.
Yes, sir.
Yeah. So I was asking you, are you aware what is final tax regime? Have you ever heard about this?
No.
Okay. So final tax regime basically refers to a situation where certain types of incomes are taxed in a separate block of income. Okay. So, and whenever someone is either paying that money, they deduct withholding tax on it, and that's it. Beyond that amount of withholding tax, nothing is nothing is applied. No tax, other tax rate is applied on it, and that becomes the final tax on certain on those incomes like royalties or interest or commissions. So in Saudi Arabia, sorry, in Qatar, these type of incomes are subjected to a final tax of 5%. Uh, UAE does not have a final tax regime, by the way, just for your information. So
How does
separate.
it differentiate in a final tax regime? I mean, final tax
So it's a different.
and
That's what I was trying to tell you. It's a way of uh, segregating certain incomes from the mainstream. You understand, and subjecting them to tax, which is basically withholding tax. The payer, the client, the customer, usually they will withhold that amount of tax, and that's it. And once they have withheld that amount of tax, they will be required to deposit the money to the tax authority on their own, the customer who usually. But this guy, this company, which is a service provider, for example, um they what will happen is that they will when they're filing their return, they'll say, look, we earned such and such amount of royalty or interest or commission, and our clients already deducted 5% on it, so we are not even going to include this amount in our mainstream income. We'll keep it as a separate block because they were already taxed, and the amount of tax that was withheld on these incomes, that is a final tax regime. That's a final tax on these incomes. So they will not be subjected to tax again in the normal manner, or the that zero rating, and then beyond a certain threshold, 9% or whatever it is, they are not subjected to that kind of a taxation. Okay, in around the world, usually we call it as standard tax regime or normal tax regime, the way UAE taxes it. Like the initial part is zero rated, up to 375K, and then there's a 9% tax on over and above that, right? This type of a regime is usually referred to around the world as either standard tax regime or normal tax regime. Is this point clear to you?
yeah, I understood the point
Uh-huh.
that you're explaining me, but what is running in my head is like, in terms of withholding taxes, once the taxes are paid, okay, and that is not being calculated on the normal tax calculation. Is that what you mean exactly?
Yeah, yeah. Like think about it. Think of it in this way. Think of it in this way that there was a commission. You were acting as a commission agent, for example. Okay, in Qatar.
Mm-hmm.
Okay, and you were a company, by the way, not let's say you were a company and you were acting as a commission, or acting as a broker, commission oriented
Mm-hmm.
broker, right? So as a broker you have commission income, but you might have other income as well, like you could be engaged in other stuff as well, buying of the property and selling of the property, right? So that's buying and selling. So when you sell a property on profit, that's not commission, right? That's another mainstream income of yours, right?
Right.
Right? So
Yeah.
your profit and loss account or income statement, if you look at the breakdown of your revenue, it would contain two types of revenue. One will be the profit on sale of property, right? That's not commission.
Mhm.
Proper profit on sale of property, that's a big amount, huge amount. Let's say 70-80%. 80% of your profit is from the comprised of the gain or profit on the sale of property that you purchase for a resale. Yeah, but rest of the 20% was the commission income that you earned from other real estate companies whose properties you helped to sell as a broker, right?
Mm-hmm.
So they gave you commission. But what will happen is those companies like Emar or Nakhil or all those major names, what they will do is they will withhold a 5% from your commission. Okay, actual money that they will give you will be 95, not 100.
Okay.
You get my point? So in your
Got it.
books you had recorded full amount of income, which was 100,
Uh,
right?
okay. Okay.
You
Okay.
had
Okay.
recorded your, so when you record that income, how will you record it? By way of an accrual, right? How will you record it? You'll say commission receivable debit with 100 and commission income credit with 100, right?
Yeah.
Do you agree? The debit and credit, you agree? 100 dirham you will
Yeah, yeah,
record. Yeah. Okay.
yeah, yeah.
So receivable was standing at 100. But when the actual money came in, you found out that wow, out of my 100 dirhams, this MR company, what they did was they actually paid me 95 dirham. And they said the rest of the 5 is actually the withholding tax that we have deducted as withholding tax agents on behalf of the country. Okay. So your
It's kind
bank,
of tax deducted at source,
yes, tax deducted at source. Absolutely. Withholding tax,
right?
the other name for that is tax deducted at source.
All
This
right.
is the other name for it. So
Okay,
in India,
got
it
it.
is called tax deducted TDS, right?
Yeah, TDS correct.
It is known as TDS. Yeah. So this is, yes, yeah, absolutely right. This is a TDS. So that 95 that way they connected, rest of the 5, you will also credit the commission receivable with that 5 also, and you will
Mm-hmm.
record it as withholding tax or TDS in your books, right? So you will
Yeah.
while filing your return, what you will do is from the total income that you had, you will remove you will remove the income which was from commissions. Why? Because on that 20 dirhams of total income, you suffered 5% withholding tax by the real estate companies like Emar or Nakhil, etc. You'll say that this income I'm not going to keep in the mainstream standard rated regime. This is taxed under a different regime. Okay, that regime is called the final tax regime. Is this point, does it make sense
Yeah.
now you? Yeah.
Yeah, got it.
So you'll pay the normal tax or standard tax on the 80 dirham, not on the 20 dirham of the commission income, because that was already taxed and you paid a final tax on it, and that's it. That entire final tax, that is not a tax credit, by the way. That tax, that 5% on the 20 dirhams of your commission income, that tax becomes your income tax expense, because you, that's not a tax credit. It will become an expense. You will not be able to recover it. You'll simply say that this much amount of tax I have already paid. Okay, got it?
Okay, and the whole income of the commission is not part of the calculations of our books, correct? If I'm not wrong, it will not come under the calculation of our, tax calculation, correct?
Yeah, yeah. Tax calculation is the right word to use, not books. It is still part
Yeah,
of our books,
it
but
is
not
part
part
of the
of the.
books
Uh,
calculation.
Calculation is the right word. Yes, I agree. In the tax return, you'll simply say that I'm separating these. That's why the word separate block of income. Right? So this
Yeah.
income of
Oh,
20 dirham that was on commission, it, you will simply disclose it. That look, I am disclosing it as a separate block of income. Why? Because this has already been taxed. Money has already been deducted. Tax has already been deducted by the client on this amount. So that's
the
how
whole income you mean, right? The commission full income, correct?
commission full income. Yes, the full
All
income
right.
we're
Got
going
it.
to remove. We're
Okay.
going to separate it in a separate block of income. Okay.
Okay. All right.
The tax rate specified in the agreements involving government ministries, other government entities, authorities, etc. So, on such government related matters, again 35% tax rate applies. Okay, when you sell to government, there's a higher 35% tax rate would apply. So in Kuwait, there's a slightly different percentage. The Kuwait offers only or implements only 15% of corporate tax in Kuwait, and this law has been enforced since 2008. But the interesting point is, before 2008 version of the corporate tax law, since 1955, Kuwait has had income tax. Decree law number 3 of 1955. So it's not, the tax, corporate tax is not new in the region. It has been there. But the proper format corporate tax came in UAE in only in 2022 and was implemented in 2023. Now
So
that
in
was,
Kuwait, it was already there, being implemented in 2008 itself.
yeah, it has been there in Kuwait since 2008. Yes. Okay.
So they were paying corporate tax of 15% from
Yes.
2008 onwards.
2008 onward. Yes. It has been
Okay.
there.
All right.
Okay. Um,
Okay.
Now, we're going to go to the second category, second regime of the UAE. Okay. So in
Mm-hmm.
UAE, the qualifying free zone person regime, which is a very, very interesting regime, uh, is that whatever your qualifying income, that would
Mm-hmm.
be subjected to 0% tax rate. So for
Mm-hmm.
we'll have to understand what is meant by qualifying free zone person. So if a company, if a person is ascertained or proven to be a qualifying free zone person, and it's an elective regime, it's not compulsory. So the person has a choice. They want to
Normal
file their,
regime,
sorry,
they can offer a normal regime, which is 5%, standard regime, which is 5%, or they
yeah,
can go for an
yeah, they not 5%,
provided they meet the
9%,
condition. Ah, sorry,
9%.
9%. Sorry, yeah.
Yeah. So yes, that's a standard regime. So they can opt or elect to file their taxes under the standard tax regime as well, even if they're
Mm-hmm.
qualifying, even if they're eligible for this 0%. So someone would one could easily ask this question: why would a person want to let go of the 0% benefit, right? 0% benefit on the entire qualifying income, and 9% on
The
non-qualifying.
simplest thing is like just buying opting for a qualifying, as a free zone. I mean, opting for a 0% regime
Mhm.
doesn't mean that they're gonna get it. They need to satisfy the condition which has been.
Ah, absolutely, absolutely. You're right. It's because of the compliance hassle, they might want to go easy on themselves. So they say that,
Yeah,
maybe
it's
it's
not a
not.
straightforward single button, just click and go.
Uh,
You need
Correct.
to satisfy the
Oh yeah,
conditions.
yeah, yeah. You can, and the interesting part is that now around the world, actually, the entire tax regimes around the world have become self-assessment regimes. You getting my
Mm-hmm.
point? Why do we call? What is the meaning of self-assessment regime? Any idea
Um,
what is
no, no,
self-assessment?
no, no.
Self-assessment means that nobody will police you on it. Whatever you file, unless there is some obvious mistake in your filing, the tax authorities will blindfolded, accept your tax return, and your tax return will become the assessment order for your taxes in the country. So you are your own judge basically for tax.
Okay.
That's self-assessment regime. So in the world right now, there a few a few years from today, around 20 years back, 2 decades back, 15 years, 20 years back, the taxation in the world was not self-assessment based. So there were tax officers in the authorities, and when you were filing your corporate tax returns, you would first of all file it provisionally or provide it provisionally. All the technology was not there actually. There was no digital filing. It was all manual. You would prepare all the returns and everything. You would go to the tax authority. You would meet a tax officer. They used to call it tax officer or tax assessment officer, whatever it is. And you would give that, return, manually prepared printouts of your return in the prescribed format to a tax officer. Then tax officer will receive, they will give you acknowledgement, they would give you acknowledgement, and they would take some time under the law to review your return. Once they reviewed the return, after some time, then they would inform you or provide you with a document saying that okay, we have reviewed your return and this return has been approved with the amount. If there is any changes, they would identify this much amount has changed, so you have to pay more or less or whatever it is. And finally, once it is agreed and approved, that would become an assessment order. That's what
Mhm.
used to happen around 20 years back, 20, 25 years back. Okay. So, but then, then the rules started changing. The governments realized that this type of a regime, which is not a self-assessment regime, but authority assessed regime or program, this is not successful.
No.
Many people do not file out of the fear of scrutiny. So what if we change the rules to self-assessment, saying that, okay, we will blindly trust you, whatever you're filing, but be aware that if you are doing mistakes and we are able to identify your mistakes, then we may review your filing of the tax return. Or if some evidences are there, we may even open your tax audit. So,
Mm.
it could be on sample basis. It could be because of the obvious mistakes that we are able to identify. And now the systems are digital. They are intelligent. Now even latest situation is that the artificial intelligence has been introduced. So things now have totally changed, extremely changed. So even the so now people file self-assessment, and by changing the law to self-assessment around the world, the collection of taxes improved, unbelievably improved. You know, multiple times of tax collection started happening. So this is how it is. Okay. So even while filing qualifying free zone person, somebody says that, yeah, I am eligible. Tax authority immediately will not say anything, but the way they have designed their form for filing it, that by itself asks certain questions that are so interestingly designed that a person will have to provide that information, which will be a first impression proof that that person fulfills the criterias that have been provided in the tax law for qualifying free zone person regime. Okay.
Mm-hmm.
So have you ever filed a return, corporate tax return
No,
before?
I do not file. I do not
You
file a
haven't.
return, but I
Uh,
haven't filed a report. I mean, I know there are certain uh, schedules are there in terms of
yes.
certain things, but I have
Yes.
not been through everything.
Okay. So you'll see when we reach article. So there's on the qualifying free zone person regime. There's a full-fledged chapter actually in this book itself. So because it's a big regime, there are you know multiple decisions on it. So it's a detailed regime. Right now, what you're looking at or reading, this is only the tip of the iceberg. Okay. So 0%
Mm-hmm.
on qualifying income, 9% on non-qualifying income, which includes income that does not meet the conditions of Article 18. This Article 18 is the
Mm-hmm.
mother article for the qualifying free zone person. Okay, there are 5 conditions identified in this article. Income excluded by cabinet decision. So if there is if the qualifying income has been defined in Article 18, indicated in Article 18, not defined pure per se. For the definition of it, we have to go to a certain decision, a certain cabinet decision. That decision explains actually in detail what is meant by qualifying income. So this is Article 3.2, okay, of the Federal Decree Law number. What you have just read, can you repeat in your own words what is qualifying free zone person regime?
Qualifying free zone regime.
Qualifying free zone
This
person
one,
regime. Yes, this one. Can
the
you
point.
repeat in your own words what you understood?
Income that does not meet the conditions of Article 18, income excluded by tax cabinet decision.
Just focus on the first
The
one.
first,
If you can say
okay,
this much, that's good enough.
okay, the qualifying income. I don't know how to exactly put in words, but I'm trying to use. The list of qualifying incomes are there. Uh,
Yes, there is. So there is
yeah, there
one.
are.
Huh.
Yeah,
So let's say if you understood the concept or the meaning or the types of qualifying income, the tax rate that would be applied on the entire qualifying income would be how much?
zero.
0% under the qualifying free zone person regime. Agreed?
Correct.
Now there would be some part of that income which will be what? Not
Nine
qualifying
percent,
free
which is
zone.
non-qualifying income, that will be flat 9% of your income.
Absolutely. Until this point you understand?
Yeah, yeah.
Very good. Some incomes will be, they will be excluded as well. So there will be basically, it is the opposite of qualifying income. They are the excluded income. Okay.
Mm.
So the one is, so the opposite of qualifying income are excluded incomes. Okay. We'll see that. So there is
And
an
those are the
illustration.
income that will be flat 9% that they meant, right?
Yeah, there, no, actually, this excluded income, when we reach this point, you'll understand better. But if a company is earning excluded income, now understand my point very well. If a company is earning excluded income, okay, and that excluded income is like significant, quite a lot of, like the size of it is like seriously big, 10, 20%, 30%, like that. Yeah, big size of the
Mm-hmm.
percentage of revenue. Then the entire company will not be able to claim qualifying free zone person regime. So I'm just giving you some heads up. Okay, details we need to
Yeah,
talk.
I understood. I think you're talking about de minimis test.
Yes, absolutely. Yes. So you've read this before. Very good. Good,
Yeah,
good to know
yeah.
that. So this de minimis threshold, if the excluded income remains within the de minimis threshold, do you know what is the literal meaning of the word de minimis?
I'm sorry, I have no idea.
You haven't? Okay. It
No.
means too small to consider. De minimis. Latin word, too small to consider. So that's why we have de minimis threshold. That okay, yeah, this is an excluded income, but it is too small to bother about. So we're going to keep a closed eye towards it. That's what the tax authority or the Ministry of Finance says. So it's too small, less than 5% or less than 5 million. We'll read these conditions in the chapter, in the detailed chapter. Okay. So yeah, let's have a quick look at the example. So ABC LLC meets all the conditions of qualifying free zone person during 25. During the year 2000, company has earned 1 million dirham in qualifying income and 1 million dirham in non-qualifying income uh, from its branch. Now, please understand, there is something called excluded income, and then there is something called non-qualifying income. They are not one and the same things. Please understand. Okay. They are not necessarily one and the same thing. Excluded income is certain categories of income, certain industries of income, banking, for example. Okay. Or, insurance.
Fund management services.
No, that fund management is a qualifying income, qualifying activity actually. But
I'm sorry. Yeah. Sorry.
certain activities are excluded activities like banking, like insurance. Okay. So
Mm.
those type of activities will be excluded activities. But then there are certain activities which are not excluded activities, but they are simply, they are classified as just non-qualifying activities. Okay, for example, a free zone person has a branch in the mainland. That's an example only. Yeah, the two,
Mm-hmm.
three type of activities have been provided. Some are property related, and one is having a branch in the mainland, for example. So that having a branch in the mainland is not an excluded activity. It's only a non-qualifying activity. So if you have that kind of an activity, that is considered as non-qualifying income, and that amount, whatever income is
Yes.
generated from such non-qualifying source, it is taxed at the rate of flat 9%. So if you break
Right.
it down, we had two elements, right, 1 million from qualifying income, 1 million from non-qualifying from the branch in the UAE mainland. So what will happen is, the answer would be, how we will tax it is, total taxable income was 2 million. So tax on qualifying income will be 0% rate will apply, correct? So no
Mm-hmm.
tax on
Correct.
that. But flat rate of 1 million, sorry, flat rate of 9% will apply on non-qualifying income, and accordingly the liability will be AED 90,000. This point clear?
Yeah.
This is how you tax the qualifying free zone person regime. Yeah. This is,
Okay.
generally speaking, this is how it is. Okay. So, any questions in this chapter? Because guess what? The chapter 2 has completed, it has finished. Okay.
Okay. Regarding this example which you
Huh.
explained to me now,
Yeah.
if I'm not wrong, a qualifying free zone person
Mm-hmm.
do any supply to a mainland in UAE would be an non-qualifying income, and that income would be flat 9% of the total income, right?
I do not want to give this answer because I might confuse you, but if you want the answer now, I will give you. If there is a supply from qualify from a free zone, and the
Mm-hmm.
supplier is a qualifying free zone person, okay,
Mm-hmm.
they make a supply to mainland,
Mm-hmm.
that still may be a qualifying activity under cabinet decision. Right? There is a relevant cabinet decision. So when we reach there, we will see that s- supplies to mainland itself are still qualifying activities. It is not excluded activity. It is neither excluded activity, not nor a non-qualifying activity which is subjected to 9% rate. There is misconception, there may be misconception for in the minds of those who have not gone into detail, but the reality is that even if you are selling to a customer sitting in mainland, okay, and
Mm-hmm.
this may still be a qualifying activity. When you read the cabinet decision, that when we will see that the cabinet decision will identify this. You don't need, but the activity has to be a qualifying activity. Understand that the business nature of business has to be a qualifying activity. It cannot be
Okay.
it cannot be, excluded activity. If it is excluded activity, then no. It has to be a qualifying activity. Then if you make the sale to mainland, it will still remain. It will still give
No.
rise to qualifying income.
So excluded activity by default is 9%. Okay.
No,
Right?
no.
No?
Excluded activity. You used a very good concept earlier. Remember, de minimis.
Test, yeah.
Yeah, you
Okay.
cannot forget
Okay.
de
Okay.
minimis there.
Okay.
Excluded activity, as long as they are de minimis,
Mm,
they are okay.
ex-
Okay, and they will be
okay.
treated as qualifying income. The funny part is that although they are excluded activity, but because they are
Uh,
falling within the limit or the threshold of de minimis,
mm,
tax authority will keep a close eye towards those. They will not even tax them.
okay. So
They will
that
consider
5%
them.
of 5 million of the total revenue.
Ah, correct. 5 million of the total revenue, or 5%, whichever is lower.
Percent lower.
Right?
That's why
That's the
excluded.
Yeah, yeah. The types of excluded activities have properly been listed in that
Listed.
in a ministerial decision. Okay, and I gave you two examples. One is the banking activity, and the other one was insurance activity. There are others as well.
Mm,
Okay, we'll see
okay.
that. So
Okay.
if it is an excluded activity and the supply is to a mainland customer, that will not, if it will get, the company will get away with that type of an activity as long as it remains within de minimis threshold. The moment de minimis threshold is breached, that's it for the company, the entire company. The everything will go away. The entire company will
Yeah.
lose its status. So
Yeah.
excluded activities are like they're very sensitive things. You
Yeah.
get
Yeah.
into excluded activity, there's a high risk you're playing
Mm.
from a qualifying free zone person regime point of view.
So, that I mean, talking about non-qualifying income supplying to a mainland, if if that is a qualifying income, you still can get this
0%.
qualifying free zone. Yeah,
0%.
0%.
Yes. If provided that it is it is only from those 14 listed activities which
Listed
are called
activities
qualifying activities
qualify.
under Article
Mm,
2, if I remember correctly, or Article 3. We'll see that cabinet decision. Okay, so as long as it is one of those 14 activities, you're okay. That it will give rise to 0%. It will give rise to qualifying income, taxed at 0%.
Okay. All
Clear
right.
point?
All
Okay.
right. All right. All right.
Okay. So, how many regimes we studied under UAE law and UAE corporate tax law until now? One was standard tax regime. Second one was
Another one.
qualifying free zone person regime, right?
Qualification.
Now we
Yeah.
are going to come to the third regime, which is
Just stop.
called the top-up tax regime. This has been addressed in the next chapter. So there is a full chapter on it, UAE top-up tax
Mm-hmm.
regime. Okay. Why there is a separate chapter on it? Because this is a huge topic. If I start teaching you this thing in detail, we will have to close the original lecture of the UAE corporate tax law. We'll have to go into something called BEPS Pillar 2 GloBE rules.
Oh,
It's far bigger than the UAE corporate tax law actually. Okay, so it's a
yeah.
very big regime. It's a
This is for
worldwide,
multinational companies, right?
yeah, MNEs, yes,
Yeah.
multinational enterprises, yes, and it's quite complex as well, by the way. UAE corporate tax law is far easier than the BEPS Pillar 2 globe rules regime. It's far easier.
Yeah,
It's a
this is where the core concepts of the law which comes in place and has more tax regulations compared
Yeah,
to the
yeah, but it is the next big thing, by the way, just for your information. For those people who are seeking a career in tax, Globe Rules is going to be probably the highest paid, area in taxation in the coming 1 or 2 years, or a few years actually. So, anyways, we'll see that. Chapter 3 is about the UAE top-up tax regime. So, how did it happen? UAE's adaptation of the top-up tax regime. UAE's top-up tax regime is based on GloBE model rules. This is a short name. The detailed name is Global Anti-Base Erosion GloBE model rules of the BEPS Pillar 2 framework of OECD. Okay. So those jurisdictions which implement GloBE rules adapt these model rules with their country specific features, like the Model Tax Convention 2017, but that's a different story. Model Tax Convention is it's a different story. It has nothing to do with GloBE rules actually. UAE also adopted these model rules via a cabinet decision, which was cabinet decision number 142 of 2024. That's a very famous decision actually on the imposition of top-up tax on multinational enterprises. Okay. So UAE's adaptation comprises 18 articles in total. So in this cabinet decision actually, they have given 18 articles. But you should remember that this whole cabinet decision is an adaptation of something else, of globe rule, globe model rule. Do you understand what I'm trying to say here?
yeah, I get it. I get it.
You,
This
you know,
OECD they need to follow the article itself states everything about the OECD model, right?
yes, exactly. It's a copy paste with some
Mm.
modifications. Same model rules they took, but the difference is that here they have 18 articles. In those model rules, they have only 10 articles. Okay, certain
Mm-hmm.
articles are very UAE specific in this. Okay,
Mm.
so you will find that there are 8 extra articles. So in the original, worldwide globe rules, there are only 10 articles, and those articles have been identified actually here. In simplest words, I didn't reach this point. So, uh, 10, yeah, that's the next point. 10 out of those 18 articles mirror the OECD globe rules comprising 10 chapters. That's what I wanted to tell you. I wrote it actually. So is this point
Oh,
making sense to you now?
I got it.
Yeah.
So the
What
actual
are
model, the
uh,
actual globe rule was only 10 chapters, but UAE has 18.
UAE has 18, so the extra 8 are for other matters. Okay. So,
Okay.
if you can get an idea of the other are logistical, yeah, like what currency are we going to use? What will be the exchange rate? Logistical things. Maybe something on the filing dates or effective date,
Mm.
those things. So that's not a that's those are easy articles, very now we should understand this is the heart and soul of the globe rules, these chapters. Okay, we need to understand what these chapters are. Okay, so chapter 1 talks about these questions are answered by different chapters. Okay, first chapter says, are you in scope, like whether a company is at all subject to the globe rules or the pillar 2 framework or not. That's the first question, right? That gives the
Mm-hmm.
answer. So it talks about multinational enterprise, constituent entities, excluded entities, etc., etc., etc. Then chapter 2 talks about who pays the top of tax or at all. So income inclusion rule. There are two main rules that are there. One is the income inclusion rule and the UTPR rule, which is the under taxed profit rule. So these two rules basically give the answer who pays of
Mm-hmm.
the top of tax. Third, what is your income? Like, world has a different way of, every country has a different way of calculating their taxable income. Am I right in saying this?
Yeah, correct.
Yeah, India calculates it differently. UAE calculates it differently. Pakistan calculates it different. Every country has a different set of rules. Now, but 135, 140 different countries and different ways of calculating taxable income. Don't you think it is very difficult for large companies which have, multi-country presence, to, you know, come to a standardization and start having at least some sort of a standardized way of calculating income, which makes sense from a tax point of view as well. Like IFRS, yes. So every country accepts IFRS, correct? From a reporting perspective, usually they follow IFRS around the world, right? So,
Yeah.
income financial statements are better reliable because most of the countries have already accepted over the last, 2 decades. IFRS have emerged as the best or commonly accepted reporting standards around the world from a financial reporting perspective. But that hasn't happened for tax. Am I right in saying this? From a tax perspective, countries have not come to a common ground. Every country follows their own rule, right? So
Yeah.
this
That's when when there is a threshold of every, like, this BEPS model is being followed by countries which has signed up to this OECD models, right?
Yeah, the countries who have signed up, they understand the challenges because it's a huge step towards harmonizing and standardization of tax.
So,
Huge step.
so then they decided, like, the countries who signed up for this module will go to practice the common procedures which has been set under this law.
Yes, absolutely. And they started off with whom? With every taxpayer? No. They started off with the large taxpayers, right? So they said,
Yeah.
okay, let's target those countries, those companies who are multinational enterprises. So first of all, they have to be present in more than one country, right? Their presence has to be in
Mhm.
more than one country, and
Yeah, I
their
have a
revenues.
question here, by the way, before we proceed. Is that multinational by default states only if you have a presence in another country? Or isn't it like, you be having your complete income from one particular country, and let's say in UAE specific, and your total uh, income exceeds the threshold which is given 750 million.
Right.
So what happens in that case?
So uh, any company which does not have presence in
Mm-hmm,
more than one countries,
mm-hmm,
okay, more than one
mm-hmm.
country, that will not be a multinational. The name in itself suggests multinational. that is more than one nation,
Mm-hmm.
right? So multinational enterprise has to have presence in more than one country. It doesn't matter how much amount of income it is earning. If it is not present in at least two countries, it will not be considered as an MNE, multinational enterprise. Okay.
Okay.
So, anyways, the point was that this, uh, was a reason that 135 countries of the world came together on OECD platform called Inclusive Framework, and they agreed that yes, something needs to be done. So we should start, applying certain. We should start adopting the something similar to IFRS in tax also. So that's how this BEPS Pillar 2 came into being. Um,
Okay.
so what they do is they when they calculate the income under IFRS, it is called revenue, right? And there's a full-fledged standard on it. Revenue. I don't know what IFRS 15, I think maybe, right? So under the GloBE rules, there is a chapter number 3 actually. So if that's what you're looking at, chapter 3. So that talks about revenue. And the name of the revenue or the taxable income, not revenue, taxable income, that is the net taxable income that is calculated or computed under these rules. It's called GloBE income. It is slightly different from our either the accounting income, which is there in our profit and loss account, or the taxable income that we report in our tax return. It's something different from both actually, because when we calculate the GloBE income, it follows the method that has been prescribed in the GloBE rules. Okay, we'll go there. We'll gradually we're going to see this. So similarly, fourth chapter talks about what taxes
This
did
rules
you.
only after exceeding the limit.
Yes, it applies on. But the interesting point is that 750 million euros is not GloBE income. It's your accounting income. If a company is exceeding 750 million euros in terms of their accounting income, that's when they are uh, subject to Pillar 2. Okay, Pillar 2 framework. So you'll see this. It is highlighted down here. We'll reach that point. But let me quickly go through the rest of these, introductory lines of the chapters.
All right.
Yeah. So chapter 3 talks about how do we calculate that GloBE income, that standardized net taxable income. Then chapter 4 talks about what taxes did you pay. They are called the adjusted covered taxes. Okay. Then chapter 5 talks about is your ETR below 15%. This, ETR means what? Effective tax rate. So many people have a notion that it is very easy to calculate ETR. Just take the how much tax was there and divide it by the profit before tax and you get the ETR. It's not as simple as this, okay? ETR
Mm-hmm.
is calculated through finding out first of all what is referred as adjusted cover tax, like the different elements of tax that multinational enterprise subsidiaries pay. So sometimes, there are different provisions, there is different type of computation through which you compute those taxes. It's not straightforward picked up from directly from the profit and loss account. There are other things involved. There's a lot of computation involved in this. Okay. First, you find out what is the adjusted covered taxes. So that gives you the numerator of ETR. But in the chapter 3, you calculate the GloBE income, and it's not a straightforward picking from the profit and loss account. No, you start from the profit before tax, but then you make a lot of adjustments in there. So some excluded incomes you remove, some things you include, etc., etc. You ultimately you reach GloBE income. So when you have these two things available, and trust me, it's not straightforward or easy to compute these. When you have these two elements available, you divide the adjusted covered tax by the GloBE income, and that's when you get the ETR and
Effective tax rate.
effective tax rate. And you have to compare that ETR with the global minimum tax rate. So all those countries, 135 countries that came together on the inclusive framework, what they agreed was that something needs to be done about taxation, right? So so many people in the world are getting, so many countries are getting ripped off because of the multinational enterprises who are getting away with paying very little amount of taxes. So as a campaign, as an effort, they said that we should pay at least a certain amount of tax. And what should that be? Everyone agreed that it should be at least 15%. So those large companies, multinational enterprises, should pay a minimum tax rate of 15%, effective tax rate. So that's why we compare the actual ETR, actual effective tax rate for those multinational enterprises with 15%. And if there is a gap, then that means more tax needs to be paid. Do you agree?
Okay.
And
Okay.
that difference is the top up tax.
That difference, the top of tax.
Get it?
Okay,
Like
15%
uh,
plus top
the
of tax. Okay.
actually the
Mm,
15% less the actual ETR. Like
mm,
you can, people like you, mashallah, who are accountants, they would even analytically they'll be able to identify. Like,
okay.
yeah, I'll give you an example. Think about UAE. What is the rate regime, standard tax regime here?
9%.
You can't say 9%. Why are you
Okay.
ignoring 375K,
375. Oh,
right? So on the
mm,
first 375K, there's 0%.
0%.
Above that is 9%, right?
9%. Yeah.
So what would be the effective tax rate? Will it be 9% or less?
Effective tax rate will be 9%, right?
No, no. Think about it. Your net tax revenue, your net taxable income, some part of it went untouched. You did not pay tax on it. You paid 0% tax on it. You paid tax
Uh,
on
I mean,
only that part of the net taxable income which was above 375K.
not on the effective taxes. There are some part of it, which is you're talking about from 0 to 375, we not paid anything.
Yeah, exactly.
Uh,
So when you
mhm,
take that effective tax rate ratio, what will
mhm.
you do? You will take the entire income, including that 375K, right?
Yeah, yeah,
You get my point?
yeah. I got it, got it.
So the resultant ratio that will come, it will be distorted from 9%. Don't you think
Mm-hmm.
so? Because because 9% was like, imagine, remember this example? Imagine this example of the the standard tax regime we saw earlier. This one, you remember this? How much was how much was the net taxable income in this illustration?
Oh,
1.375.
1.375.
The initial
Yeah,
375 we did not pay anything. But
yeah, adjusted. Yeah.
yeah, if you say that 90,000 and 1 million, there is an effective tax rate of 9%, I will accept. I agree. Okay. If we consider only these two, it is fine. But we are not considering only these two. We are considering this 90,000 with what?
With 1.3537. Yeah,
So do you think it will still be 9% or different?
be different. Yeah,
So do you think it will go down or up? It will be less than 9% or more? The
it should be less than
denominator
9.
is
Mm-hmm.
increasing, yes.
Yeah,
So what will it be? Less than 9% or more?
it should be less than 9%, right?
Less than 9%. Absolutely, yes. It would be less than 9%, right? And
Yeah,
if this income
correct.
increased even more, let's say if it were, let's say 2 million or 5 million or 10 million,
In
this
any
will
case, in any case, in
uh,
any case.
it would go far below 9%. So the whole point is that in UAE, without having to deep dive, you can immediately tell in UAE, is that minimum global minimum tax rate being achieved by the tax authorities? Meaning, are companies paying enough tax here from a global minimum tax perspective?
No, they're not paying.
They're not, na? Because they're
They're
paying
not.
very,
They're not.
they're hardly paying 9% or less, 8
9%.
point
Yeah.
something,
Yeah. Less. Yeah. Yeah. 8 point.
8.7 or 8.8% tax they're paying. That's the effective
Yeah.
tax rate. That's far
Mm,
below, don't you think so? Far below. Like even if they were
yeah.
paying 9%, okay, for 1 second, let us assume they're paying 9%. Even if they
Even
were
then, it's
paying
less.
9%, then how much they are
Hmm.
not paying? Almost
6.
6%, correct? So
Hmm.
that, you know, for multinational enterprises that are operating in UAE, don't you think that the starting point would be 6% of tax, unpaid tax from a global minimum tax perspective? That's what the top up tax is about. Okay. Anyways, I'll continue with our discussions. So, I was telling you that this was the question that we asked. Is it less than 15%? That's the top up tax. The gap is the top up tax. Chapter 6, how much of your income is excluded for substance? That's another question that is asked, substance based exclusion or inclusion. And then there is another question, did any merger and acquisition M&A activity change the picture? So if there is any change in the group structures, how do we deal with that? Then there are more chapters, chapter 8 and 9. How do you know filing of the return? Chapter 8 talks about filing of the return, payments of it, and then the transitional provisions, chapter 9. And chapter 10 is all about definitions. Okay, what do all jargons of the globe rule? These are the chapters in the globe rules. Okay, so all of the, so first one that we talked about, who is covered to, it defines the boundaries of the globe rules. It talks about certain fundamental concepts. Chapter 1, we are going to quickly get a grasp of this because this is still part of the UAE top up tax regime. Okay, so one concept that we've been talking about, what is that? MNE group, right? So what does MNE group mean? The group that earns 750
Which
million euros in annual
gl-
global
globe.
consolidated revenue or turnover.
Yeah.
Okay. Is this profit or is this revenue?
Revenue.
Revenue, correct. Which has at least one entity or a permanent establishment in a jurisdiction other than that of the ultimate parent entity. This point is the actually the question that you had asked. What about those entities which are earning 750 million euros, but they are only in UAE? Are they multinational enterprise? Are they subject to BEPS Pillar 2? So they will not be subject to BEPS Pillar 2. Why? Because they're not even MNE groups. In order for
Mhm.
that company to be MNE, this second condition also needs to be met. They are meeting the first condition, but this
Mhm.
second condition they're not meeting, right? Which means at least one entity or permanent establishment has to be in a jurisdiction, meaning country, other than that of the holding company, ultimate parent entity,
Oh,
which is UAE, right?
okay.
So they have these
Hmm.
terminologies are globe terminologies, ultimate parent entity. But this is anybody who has been in Big Four or major entities, etc. They know they may have heard this before, ultimate parent entity, because in Big Four when they're about to accept an audit engagement or tax any engagement for that matter, they have to do a, KYC kind of situation, know your customer, know your client checklist. So they have to look at the family tree, etc. And in there, they find out about the ultimate parent entity, who owns this group, right? They can even sometimes they will know about the taxable presence in other countries as well. So usually that taxable presence is, if it is a permanent presence, fixed place, it is known as permanent establishment. So this definition has been kept broad by bringing in the permanent establishments into picture as well. Although permanent establishments may not be a legal structure, very important for us to remember this point. Sometimes a clever entity may say that, look, we are not even going to open a branch in another country, but still they have taxable presence. In the last lecture, if I remember correctly, I may have given you an example of Formula One in India. Did I give you, or SOSA, Strategic Oversight Agreement,
Yeah, yeah. About that.
Hayat Regency? Yeah,
I had the agency.
Regency, right? So this is possible that the A company may not even have a branch or another legal structure present in a country, just taxable presence, but but based on a fixed place of business. So if that happens, they will still be considered as multinational enterprise. Okay,
Yeah.
that what we just discussed was the definition or concept of a multinational enterprise. Now what we are discussing is the concept of a constituent entity, CE. Okay. So what is a constituent entity? Name, what is the name suggest? What is this is the word called constituent. So have you heard the word constituent before, or have you heard the simple word constitute? To constitute,
Constitute is what
uh,
yeah, constitute is which widely,
everyone knows. Yeah,
yeah.
constitute means to comprise of something, to be a
Mm.
part of something, right? So
Include,
this,
yeah.
yeah. So from that word, this word constituent has emerged. It came out of constitute. So constituent entity means it is that entity which constitutes a multinational enterprise group. In easier words, right? So it's a
Hmm.
part of the multinational enterprise group. A constituent entity is any of the following. It is any entity that is included in a group. There's no mention of the word multinational enterprise. It is an entity that is part of a group or any permanent establishment of a main entity that is within paragraph A. So sometimes, as I mentioned, that SOSA, remember always the SOSA example or the Formula One circuit example in Delhi. It can be a permanent establishment also. Sometime, meaning under the BEPS Pillar 2 framework, even a permanent establishment can be seen as a constituent entity. That's a $1 million gyan that we should remember. Okay. Permanent establishment also can be a constituent entity under BEPS Pillar 2 framework. Okay.
Okay.
A permanent establishment that is a constituent entity shall be treated as separate from the main entity and any other permanent establishment of the main entity. It will be seen as a separate entity, and this concept has been kept by other doctrines of international taxation as well. For example, Model Tax Convention 2017. Even in there, this point has been upheld, it has been accepted. Even in UAE corporate tax law, if you look at it, when the in certain places, when there is a mention of permanent establishment, they say that the law will treat permanent establishment as a separate entity from the main entity. It has been mentioned in UAE corporate tax law as well in certain places. Okay. A
Okay.
constituent entity does not include an entity that is an excluded entity. Okay. When we go into there's a lot more detail. By the way, just to let you know, if you ever feel like you want to learn or understand the concept of this constituent entity, etc., what you can do is you can go on my channel, and from there you can uh, yeah, it is there. This is my channel. This it's M- Muhammad Al Tax. You can see there. If you go there, what you will be able to see is that I have a full-fledged playlist on the Globe Pillar 2 framework. It already has how many videos? Quite a few videos
What?
actually. The,
49.
quite a few videos are there. I don't know, 40, 49, 50 videos I've already put in. It's a huge framework. Okay. You if you want to learn about it, if you want to see what this is all about, just look at the pilot video. It is in a lot more detail here. So I'll just type the thing for you so that you know where to go or where to find it. I'll just simply write it here. There you go. If you ever, you can subscribe to this if you
Sure,
want.
sure, sure,
Okay,
sure.
so anyways, I will leave it at that. Right. So as we were talking about a constituent entity, we discussed what is a constituent entity. Permanent establishment, that is a constituent entity, shall be treated as separate from the main entity and any other permanent establishment of that main entity. And constituent entity does not include any entity which is an excluded. Some entities are excluded. They are not, their incomes, etc. They are not made part of the globe income. You understand what I'm saying? Like an investment entity, for example, investment fund related entity, for example. So such an entity is considered as an excluded entity. So there's a very detailed discussion on which entities which entities
I
qualify
mean, those
for.
are the excluded activities you mean, like,
No, no, not activities. They are entire entities that will not be considered. And I mean, your point is also, it has weight. Certain activities, because of the nature of activities, certain entities may be excluded, like the investment fund, right? So it is possible that they may be, or purely a government entity, for example, because government entities are, the whole idea of a government entity is that it is not competing with the private sector, right? So that may be an excluded entity. Got it? More details are here. You want to know about what is an excluded entity? This is. Can you see the categorization?
yeah, yeah, maybe.
Government entities are excluded entity. Non-profit organization, welfare companies, welfare entities, they are excluded entity. Pension funds, investment funds, or real estate investment vehicles, all of them are excluded from the top of tax regime. Okay, investment
These
entities.
these are part of the BEPS
Yeah,
OECD model.
this is part of this provision is part of the BEPS model. These entities are excluded entities. They will not be considered, their incomes, their activities will not be considered as part of the globe income. They'll exclude it. Any tax, or if even if there is tax related to these, it will not be considered. Do you get my point? These
Yeah,
are kept outside the calculations, all the calculations under the
yeah.
globe rules. Clear?
Okay. Okay, got it.
Okay, so that was constituent entities. Now we're talking about ultimate parent entity. This is the real culprit, right? This is ultimate parent entity. This is where the whole fun and games start. This is the mother entity. An ultimate parent entity is an entity which owns, directly or indirectly, a controlling interest in another entity. Okay, holding company. We know, we usually know it as holding companies, right?
Yeah,
So in globe rules, instead of calling them holding companies, we call them as ultimate parent entity. But remember something, holding company is the same as
parent entity.
parent entity. But ultimate parent entity, what would that mean? It is only one of the companies in the group, which is the greatest grandfather of the group. No one is
In
above
other
that.
words, we say complete control or
Complete control of the entire group. Yes,
group. Okay.
you get my point. Now,
Yeah, got it.
there may be intermediate parents, like
Mm-hmm.
for example, in UAE there is a famous group called IHC, International Holding Company. Have you heard about it?
Nope.
It's a huge
IFC.
company. IHC is it has $1 trillion market cap. So it's a huge company.
Okay.
Okay. So
Mm-hmm.
one of the subsidiaries of IHC is Alpha Dhabi. But do you know how big is Alpha Dhabi? Again, it has hundreds of subsidiaries. So don't, so if I say that Alpha Dhabi in its own right is a parent entity, will I be wrong?
No.
It is a parent entity, right?
Yeah.
But this company itself is the daughter of another entity which is the ultimate parent entity called IHC. Am I right?
Okay. Okay. Okay.
So
Okay.
sometimes there can be one entity could be a parent. but itself it will be just like our families, right? Um, uh, our parents are the children of our grandparents. That's how it is, simple. So the ultimate parent entity is the ultimate parent. It's the topmost in the food chain. Okay.
Okay. Okay.
The key point is that the ultimate parent is not owned with a controlling interest directly or indirectly by any other entity. Okay,
Mm-hmm.
that's the key point. Ultimate parent is not no longer owned. That's the end point. Okay, ultimate parent is usually it is owned by a natural person. A sovereign wealth fund. Have you heard this terminology before? Sovereign wealth fund.
No, I've not heard of it, but the sovereign wealth fund is there in, I think sovereign wealth fund is, I don't know about UAE, but this one, KSA has it.
Okay, very good. Do you know what is the name of the sovereign wealth fund of KSA? It's
No, no,
called
no.
PIF.
Mm-hmm.
Public Investment Fund. Yes. So you are absolutely right. These countries have their government funds basically. They are called sovereign wealth funds. Uh, Saudi Arabia, there is PIF, Public Investment Fund. It's a giant, huge fund, $1 trillion kind of a fund. In UAE also we have multiple. ADIA is there, Abu Dhabi Investment Authority. It's a sovereign wealth fund. Mubadala is there. Have you heard about the name Mubadala? Very famous name.
No, these are listed by the way.
Not necessarily. These are government funds basically. So sovereign
Oh,
wealth funds usually may not be listed. Not necessarily. Okay. Their
how would a
subsidiaries,
normal person want
many
to
many subsidiaries are
hold?
listed.
Okay.
The whole point of having a sovereign wealth fund is to own subsidiaries that are hardcore private sector. Right? So
Mm,
that's how it is. So like in Oman, we have OIA, Oman Investment Authority. It's the sovereign wealth fund of Oman. And it has many companies that are listed on the stock
but
exchange.
the sovereign wealth fund should be publicly available to invest, right? If I'm not wrong.
No, no.
Not
Look
necessary.
at the name, sovereign.
Okay.
So what does that word mean? Sovereign. Sovereign means what is sovereign? Sovereign means a government basically, a ruler
Government governed
that has
by.
absolute authority in a country, the ruling body or the ruler, right? So sovereign wealth fund is that wealth fund which is set up by the government of a company.
And it is not necessary to be available for the public.
Not necessarily, it is not available. Simply,
Uh, okay,
that
just
fund is directly and 100% owned by the government of the country.
by the government of country. Okay.
But that fund sets up other entities which are like really giant entities. Like in UAE's case, you might know like major companies that are there, like Etisalat, Do, or Emirates Airlines, or many companies like that. They may be owned by the sovereign wealth fund. It is quite possible. So they'll be
Hmm.
listed. You'll see that companies are available for listing to general public. Sovereign wealth fund is not available to general public. It's the money that is owned by the government directly. Okay. So a
Okay.
sovereign wealth fund that meets the definition of a government entity is not an ultimate parent entity. So, it has been identified in the GloBE rules that this will not be considered as an ultimate parent entity. Now, excluded entity, we saw different types of excluded entities. Government entities are there, non-profit organizations are there, pension funds are there, investment funds serving as ultimate parent entities are there, and real estate investment entities are there. All of these are excluded entities. We discussed this, right? Investment entities located in the UAE are excluded from top of tax regime. Now, another question: who shall pay UAE top up tax? So the answer to this is the constituent entities will pay. You remember the concept of constituent entity? Any entity that is part of the multinational enterprise group, right?
Yeah.
They are
Hmm.
considered. So they will pay. Joint ventures, JV subsidiaries, and reverse hybrid entities. Don't worry about this word. It may seem difficult, but it's not too difficult to understand. I'll explain to you. These, these are basic concepts. Constituent entities. Joint ventures easily understandable. I hope you understand what is joint venture. Do you?
If you could explain me, it would be better.
Two companies usually, when they
Hmm.
sign up a kind of a partnership agreement, they say that okay, we'll operate together jointly. So that's when we say that a joint venture has been
Two
established.
different companies, right?
Two different companies, yes.
Yeah, two different companies join hands together to,
Yes, to conduct a
yeah,
project or
yeah,
yeah. So so they don't lose their own status. They agree on terms of operation. One company may take control, other may finance, like that. Different terms and conditions may be there. This joint venture, especially in oil gas sector, is very huge. There's it has been there for a very long time. So operators, non-operators are there. So usually. One entity comes with the expertise of operating the oil wells, other company comes with financing of it, and that's how it is. So, the word reverse hybrid, I will explain to you what it means. Forget the word reverse. Just focus on one word. What is that word? Hybrid.
hybrid.
Hybrid. What is the literal dictionary meaning of the word hybrid? You know about the cars, right? Hybrid cars. What are those? What are those cars? They run
No,
on
sir, if you
petrol as well as batteries,
batteries, both
right?
dual.
Yeah, that's why they call it hybrid. Hybrid means having two different natures, having two different features.
It's called flexible adaptability of two different features, right?
Correct. Yes. So, then the literal meaning of hybrid means two, there's nothing flexible or non-flexible. Two features, two different features.
Two different features. All right.
That's hybrid. Okay. So, some entities are of hybrid nature from a tax point of view. In one country, that entity may be seen as a transparent entity, but in the other country, same entity may be seen as an opaque entity. Now, what is transparent? What is opaque? The I don't know if how much you're aware of the India taxation, but in certain countries like India or Pakistan or sometimes even UK, there is a concept of association of persons or partnerships. Have you heard this before?
Can you repeat, sir? I didn't get it exactly. What? Association of what?
Association of persons, AOP, association of persons, or the easier word, partnership, for example.
Yeah,
I'm sure,
partnership is, yeah,
yeah,
yeah, partnership is very commonly used. So
commonly.
association, AOP, I've not heard of.
Okay, so you can see you'll in your Indian law you'll see that there is something called association of persons, and it is referred to not only partnership but some similar other structures as well, like trusts, for example. But anyways, whatever the name it is, the point of a partnership in India or Pakistan is that it is not taxed at entity level. Okay, that entity is not taxed. The law says that if the books are being maintained for such an entity, so when we reach the bottom line net profit before tax, that profit will be allocated to both or more all the partners in that partnership. And those partners in their own right, in their own tax returns will be taxed, but not the entity, not the partnership entity. Is this point clear to you?
Yes, sir.
Sure.
Yes, yes.
So the taxation of that entity will happen when the profit is treated as reached in the hands of the partners. Taxation will happen at partners level rather than the partnership level, owners level. Okay. So what we are saying is that in case of all of these types of entities which are located in UAE, and they have been in a fiscal year, they shall pay the top-up tax if they meet the conditions, provided that they are constituent entities, provided that they are part of the multinational enterprise group. Top-up will be levied to ensure that minimum effective tax rate is achieved, that 15%. Effective tax rate, ETR, is the ratio of the adjusted covered taxes to the net pillar to GloBE income. That's what I explained to you earlier as well, right? Effective tax rate. For that, we have to separately calculate the numerator and separately calculate the denominator. Remember this point?
Yeah, I remember.
Yeah. So that's how we calculate the effective tax rate, and then we compare it. The
The
top
difference
of
of the
tax.
6% you're talking about, correct?
Yes, absolutely. The top up tax is the extra tax needed to ensure that ETR meets the minimum rate of 15%. Okay. So aligned with the country by country reporting. So you
Yeah,
can, you know,
it's not 9 and 15. It's if you paid 9, the balance is adjusting up,
hmm.
reducing the 9% which is being paid. The 6 would be the
Yes,
payable amount, right?
will be the extra, will be the top up tax that will require to be paid.
Tax.
Yes. So JVs and JV subsidiaries treated as separate groups for GloBE purposes with their own income inclusion rule and under tax profit rule allocation. So they are not said, mentioned here in detail because they are quite, they require a lot of time to explain. There are quite a few things included in the IIR or under tax profit rule. Key nuances: a group can be subjected to the rules even if the UPE, ultimate parent entity, is in a non-adopting jurisdiction. So, it is possible that a company is operating in a ultimate parent entity, the mother company, the holding company, is in a
Mm-hmm.
country which has not yet signed up for the
Mm-hmm.
GloBE rules.
Mm-hmm.
I'll tell you, Oman may not have signed up, but actually, the latest news is that probably Oman is also becoming subject to it. But there may be certain countries who have not signed up for the
Mm-hmm.
GloBE rules. So ultimate parent entity may be there. Ultimate parent entity so the group can still be subjected to it. Ultimate parent entity will be in a country that does not even accept GloBE rules. So the when we go into the details of the website, you will find that okay, that parent entity we cannot control, or that parent entity may not pay any top of tax or anything, but the very next entity in line will have to abide by it in a country which accepts the GloBE rules. The IIR applies to applies to any parent entity in any adopting jurisdiction down the chain. You see this word, down the chain? That's what I was trying to tell you. So it's a group, right? There is
If
a
the parent entity do not follow it, if the
there will be a
parent entity do not,
there will be an intermediate
okay,
parent. You remember IHC example? Ultimate,
okay, okay, got
yeah,
it. Well,
ultimate parent entity is IHC. The
okay,
intermediate parent entity is Alpha Dhabi, right? So it is possible.
okay,
Imagine for a second that IHC is in UAE and Alpha Dhabi is in another, let's say in Saudi Arabia, just for discussion's sake. It's not real, but I'm just saying discussion's sake. So if the intermediate, let's say UAE did not accept GloBE rules, okay? So IHC is not subject to it. Okay, I understand because IHC will say that oh we will not do anything because UAE has not agreed to the GloBE rules. But what about the next in line, Alpha Dhabi, which is in Saudi Arabia? And Saudi Arabia has accepted to, let's say, GloBE rules. Then under the GloBE rules, that second company, which is an intermediate parent, that will become subject to GloBE rules. You get my point? From that point,
yeah,
the GloBE implementation will start. Okay.
okay.
There is an
It's kind of similar to DTA if I'm not wrong. If the DTA is not signed between two countries, then it will be taxable. The global income would be taxable at the country that you are a citizen of it. Similar to that,
yeah, something similar to that. Yes.
right? Okay.
Okay. Example of the chapter one. There is a scope. A multinational group headquartered in Germany has consolidated revenue of 800 million euros in 2025. It owns subsidiaries in Ireland, where there's a tax rate of 12.5%. Singapore only 10% rate, and Brazil 34% rate. Different rates are there, right? Subsidiaries.
Mm-hmm.
Ultimate parent is where? In Germany. The group includes a wholly owned pension fund in the Netherlands, the that manages employee retirement assets. So how will this apply? The group is in the scope because first of all revenue is higher than the 750 million threshold, right?
The total, right? The total revenue
Yeah.
altogether, the
Yeah,
subsidiary
but
and
it
everything
has been
together.
mentioned already. Consolidated net.
Consolidated. Okay, I'm sorry.
Yeah. So
Okay.
exceeds first of all.
Mm-hmm.
However, the pension fund is an excluded entity under chapter
Mm-hmm.
1. You
Mm-hmm.
remember we talked
Yeah,
about
the
it.
excluded list. Yeah, you showed.
Uh, so a pension fund is one of the categories of excluded entities. So their income will not be considered. However, the pension fund is excluded entity. Its income and assets are ignored for GloBE purposes. The Irish and Singapore subsidiaries are fully within scope. Okay. Uh, and we'll have to see the Brazilian as well. So maybe Brazil has signed. If Brazil has accepted the GloBE rules and signed up on the document, then even this subsidiary will be considered as part. Okay. So that was
If
this was
if it is not signed and then still we need to add, right?
no.
That's
If
what you
if
told.
the Brazil did not sign up, then
Mm-hmm.
then how will we implement the GloBE rules over there? A country has just not accepted it. Then you can't implement, right?
As far as you're
Com-
crossing
com-
the threshold and your parent company,
yeah, but think about it, na? It's a religion. So if you're a Christian, you don't believe in another religion. Can you force? Can somebody force you to accept Hinduism or Islam? No, you will only do something which you believe in, which you have accepted, right? That's the whole point. A country has not accepted GloBE rules. You can't do anything about it. You can't. The countries are sovereign. Right? Sovereign means absolute authority.
but the point that you explained to me before was like, uh, if you have if you are a multinational company, if you have a presence in another company where that country does not accept the or not signed up the OECD module,
Mhm.
but still like you need to pay taxes for the
Yeah.
whole revenue.
So yes. So that's the whole point. You good point raised. So in this situation, let's say Brazil has not accepted it, but we know that the ultimate parent entity has accepted it. Ultimate parent entity is in a country, Germany, which has
Mm-hmm.
accepted it. So,
Mm-hmm.
so there. We will see that the ultimate parent entity may ultimate or even intermediate parent entity may be subjected to taxes for for the revenues that have arisen in Brazil. So you're right. At Brazil level, it will not happen, but the parent company of this subsidiary may be subjected to it because of this subsidiary. The impact of this subsidiary will need to be absorbed by the parent entity. In a
As is
country,
part of the same, yeah, it's part of
yeah,
the same
in
group.
a country where there is GloBE rules, right?
Okay,
I'm talking
okay.
about the larger group, right? So we said that the ultimate parent is in Germany. What about there is another parent, intermediate parent? So we'll have to see that. Okay. So the immediate parent is subjected to GloBE rules in that scenario. Can I move to this second because there are 10 chapters we have to go through. Yeah.
Yeah.
Okay. So second chapter in the GloBE rules is something that we call as charging provisions. So kind of a scope chapter. First thing was only it was still about scope as to which entities are in scope, and but the second one is about charging provisions, the two interlocking rules. So income inclusion rule and all that. Let's go through this to establish the legal mechanism that imposes the top-up tax. How? First thing is income inclusion rule. What is this rule? It operates like a top-up tax imposed on the parent entity. So basically, parent entity has to bear this rule. It applies to the ultimate parent entity or even an intermediate parent entity in a jurisdiction that has adopted the GloBE rules. So intermediate parent entity, they are sometimes required to include the income of a subsidiary. The parent pays a top-up tax equal to the allocable share of a low tax income of a constituent entity. That Brazil example that we were just discussing. You get my point?
I'm just trying to recollect that point. Uh,
What did we say here in the previous example? We said, Ireland, Singapore, they will pay because there is globe rules already there. But there was no mention of Brazil here, right? So what did we say
yeah.
about Brazil? We said we'll have to see if the Brazil has not agreed to globe rules. Yeah. So what will happen with
Hmm.
Brazil then? Brazil, you can't force Brazil to accept, right? Then what will happen? The immediate parent entity of this subsidiary, which is in Brazil, that
Mm,
entity will be required to pay for the tax, for the gap of tax that did not have that did not take place in Brazil. Brazil should have paid
that's
top up tax if their tax rate was less than the 15%. But the funny part is that what we did not see here was that the rate of tax in Brazil was how much?
34. Uh,
You get my point? Why Brazil was not talked about here?
was not included. Okay. So super
Why would Brazil pay
sensible
anything
point. Yeah, when the tax rate is, more than
so high?
15%, then the,
Uh,
OECD model doesn't, yeah,
yeah, they will
falls
not
into
say,
it.
"Oh,
Yeah.
come on, you are already paying like more than twice of what we need you to pay." So forget, khalli walli.
So,
They'll-
which means, in other words, the OECD model, which has been signed by the countries, are less taxed than 15%, correct?
No, no, signed has happened everywhere. Signing has a why?
Okay.
Like, let me give you an example. Okay, tomorrow the Ministry of Finance of UAE increases the rates of
Mm-hmm.
our standard tax regime to 20%, just like Saudi Arabia. Okay, we'll say
Mm-hmm.
that okay, up to the first 375,000 dirhams, 0% tax, and above it, how much? Let's say 20%.
20%.
20%. That's a big rate. Okay, forget 20. Let's make it 25%. Okay, 25 or 30%.
Mm-hmm.
Big amount, major amount. But it does not change the qualifying free zone person regime. Now, those entities that are in a qualifying free zone person, what is happening with
Mm-hmm.
those entities? How much amount of tax are they paying?
Uh, Zero.
Exactly. Do you think that is
Uh,
that the globe rules will keep a closed eye towards qualifying free zone person?
yeah, yeah, this was a question I was kept it for, to ask you in the last. What happens to the qualifying free zone because they don't pay taxes? So for them, OECD
Uh,
model comes into place automatically moment when they cross 750 million if they are a multinational company.
So
So
that answer will be given by that cabinet decision 142, if you remember. And to my understanding, even the government of UAE, I mean, they are sovereign, but in the interest, in the good taste of cooperation, worldwide cooperation, the UAE government would also be probably not take a position where they say that no, no, we want to give this benefit to the qualifying prison person. It because then it will become a kind of a preferential tax regime. Like you're
uh,
giving, you're not charging anything literally from those people who are from those companies who are situated in a free zone. So that defeats the whole purpose of having the globe rule. So to my understanding, even the free zone persons, qualifying free zone persons would have to be subjected to this regime, provided that those qualifying free zone persons are part of a multinational enterprise.
yeah, and tax in general does not favor any particular country for them to make a
Yeah,
bigger revenue in
absolutely.
the country. So
Yes, absolutely.
okay,
Absolutely. You're absolutely right. Okay, got it. So
yeah,
now the
uh,
income inclusion rule is better clear.
yeah, correct.
So
Yeah, thank you. Thanks for the
parent
explanation. Yeah.
parent has to suffer for the bad deeds of the subsidiary, right?
Mm.
So to say, it's a it's a light humor to say that the parent has to suffer because of the child. The parent pays up the top-up tax equal to the allocable share of the low tax income of the constituent. That was the IIR, income inclusion rule. Mechanism: if a subsidiary has an ETR which is less than 15%, the parent's jurisdiction taxes the difference. They collect money from the parent. That it's a. And then we have another regime as well, which is called undertaxed profits rule. The secondary backup rule is that apply if the IIR does not fully capture the top of tax. No parent in adopting jurisdiction. So how does it work? By denying deductions or making equivalent adjustments to other group entities. It is possible that, okay, in one country there was a subsidiary which was which was paying a small amount of tax, and the ultimate parent was not there. Let's say there was no ultimate parent entity. So one of the ways of doing it is that the amount of tax for that particular country's subsidiary is spread across other countries' subsidiaries. So allocation to more than one group entities. That can also happen under UTPR, under tax profit rule. Does this make sense what I just explained?
No, I kind of froze with this complete UT
Yeah.
PR.
Okay. Take that example of the Brazil that we just saw. Yeah.
Yeah.
Imagine
Okay.
that imagine that instead of Brazil, it was written as, let's say, Cayman Island or British Virgin Island. There is no tax.
Taxes.
Zero.
Yeah.
Yeah. So what will happen? And the interesting part is that this Cayman Island or British Virgin Island entity did not have a parent as well, direct parent,
Hmm.
legal parent, but it was still a part of the group because of the controlling interest
Hmm.
or the control exercised, right? So how will this entity be dealt with? There is no tax in that jurisdiction of Cayman Islands. So what will
So
happen?
the parent company have to pay for the subsidiary company.
So how many entities? Let's say it's a simple group, so only four entities, five entities are there. One is the ultimate parent in Germany, then we have an
Mm.
Ireland company, we have a Singapore company, we have a Brazil company, and one more Cayman Island company. Okay. Rest of the
Hmm.
companies, rest of the countries have all signed up, or or even the Cayman Island has signed up, as assuming. But the problem is that in the Cayman Island there is no Cayman Island cannot it will not have signed up, but there is
Mm.
profit there. So what will happen is we will calculate, first of all we will calculate the tax, the global minimum tax that corresponds, that relates or associates with that Cayman Island company. Okay. Now Cayman Island
Hmm.
does not implement globe tax, like minimum top tax. They
There is
don't
there is
implement it.
no there's no tax itself in general, so there's no global tax that is signed up as well. So in
We
that
don't call it
case,
global tax. We call it top up tax or globe
top of
regime.
tax,
Yeah,
global regime.
globe regime. So we will calculate the amount of tax that should have been collected from the Cayman Island subsidiary. That tax will be allocated to the ultimate parent, Ireland, Singapore, Brazil. You get my point? For let's say,
No,
huh?
no, I didn't get that point that you're saying. That tax will be what?
Allocated. It will
Hmm.
be spread out. So these countries will collect the tax on for that was due in respect of the Cayman Island company. This is called allocation of taxes.
But how do you allocate that particular thing on the whole of 15%, or how is it?
So the at an ultimate parent level, Germany, for
Mm-hmm.
example, the German tax authority, they will be monitoring it because this is the ultimate parent. This is where
Uh-huh.
the entire
Mm-hmm.
consolidation is happening, right?
Consolidated revenue. Yeah.
Uh,
Mm-hmm.
so the entire calculations for all the subsidy, everything, it will be provided in to the German tax authority itself as well. They will look at the calculations. They'll say, okay, we've seen the calculation. We're not going to collect the entire money from you, the ultimate parent. But we will allow, we will endorse that you, share this working with the other subsidiaries in Ireland, Singapore, Brazil, saying that the taxes related to Cayman Island company, let's say they were 100, okay, 20% will be
Mm-hmm.
collected in Germany, 20% will be collected in Ireland, 20% in Singapore, 20% in Brazil, like that, or 25, four countries, so 20, no, not 20, 25%. So one fourth, one fourth, one fourth. I'm just giving an example, illustration. So that
Yeah, but there is
100%.
no rule on that, right? The parent company decides how much to be shared
No,
and stuff,
no,
right?
no, no. This is the rule. This is the rule. UTPR. This is happening under a set of already very detailed rules, my dear. It's not
Yeah, the
arbitrary.
question here is when they're allocating the percentage of the taxes would be shared between other three, you
Yeah,
know.
that this 25%, I said it. This is
Mhm.
only just to let you know. This is the actual percentage will not be 25%. The real ratio will be according to the globe incomes, the ratio of the globe incomes, for example. Okay, there is a method of allocating tax. It's not arbitrary like if Mr. Altaf says 25% to distribute to each company, that's not right. This percentage will, or there is a calculation for this percentage also. Now, how much amount will be allocated? It will be allocated according to the weight of the globe income or globe taxes. Do you understand? Like for example, Brazil has a major amount of revenue. More amount, it will be able to withstand more burden of the allocation. So more burden will go
Proportionate
there.
in other ways. Okay.
Yeah, weightage according to weight. There are set
Okay.
procedures for everything. Okay.
Okay. Okay.
Yeah, so works by denying or in the adopting duties. UTPR tax is allocated among jurisdictions based on a you look. So there's your answer. That's what you were asking, right?
Yeah, yeah, correct.
Yeah, that's your answer. And yeah, now I remember what is being said here is there is a two-pronged formula. 50% weightage. I remember now. It is written only as because of the simplification purposes. It is written like that. When you go into detail, you will find that UTPR is allocated to other jurisdictions based on a two-pronged formula. This which includes not only tangible assets but number of employees as well. 50% weightage is given to tangible assets carrying values. 50% weightage is given to the number of employees. Based
Mm,
on this formula, then the percentage allocation happens. Make sense?
okay. All right. Tangible assets and number of
Tangible assets and
employees.
number of employees. Yes. Okay.
Okay. All right.
Yeah. Yeah. So that's how it is. If you want to see, I can show you even from the detailed book. It's available for purchase. If anybody wants to do that, I can show you. It's a full. I have written full 4 volumes for the globe rules already. Okay, so this UTPR that we are talking about, it's already mentioned there. Let me show you quickly. Uh, Under the tax, this is under which volume one? This is volume one. Okay, and this was chapter two. So under under tax profit rule, can you see this under tax profit rule? That's where we are. This is the scope. Let me go to this is in the second chapter. Allocation of top-up tax under the income inclusion rule, and one more which is the under taxed allocation of top tax under the under tax profit rule. So there you go. Allocation of top-up tax for the UTPR. So this is how it will happen. 50% based on the employee proportion, 50% based on the asset proportion. This is in the chapter 2, article 2.6. This is your detailed answer. You wanted to understand how it happens. So allocation is based on employee count, number of employees in the jurisdiction, measured full-time equivalents, and then tangible assets. And this is how, 50% weightage is allocated to employee proportion, 50% allocated to asset proportion. This is the formula calculated annually for MNE group. 50% into number of employees in the jurisdiction divided by total employees in all UTPR jurisdiction
But not
plus,
on the not on the revenue.
yeah, not on the revenue, not on the revenue. This is the top up tax allocation. Means the extra tax that is supposed to be paid. This is how it happens. So I don't want to take you into this level of detail
Okay.
right now, because that's not it will not be fair with you. We want to stick to at least basics, because that's a detailed, that's a separate course. It's a very, it's a detailed course. So anyways, just hold on one second. Uh, where we were, what is that? Okay, we were talking about corporate tax. Yeah, okay, fine. So there's an example that has been provided. Shall we go into this example just to understand? And then we're going to take a break for some time, okay? 10-15 minutes break. Yeah. Let's finish with this example. Then we will revert and we'll talk about chapter 3 at that time. This is the example for chapter 2, charging provision, IIR and UTPR. So, parent co in Germany, which adopts the GloBE framework. Okay, this company owns subco, which is subsidiary co, in a low tax jurisdiction. For example, Cayman Islands, with no corporate income tax. Subco has GloBE income of 10 million euros. Okay, so this subsidiary's income is 10 million euros, and it pays zero tax. Why? Because Cayman Island does not have any tax, right? So naturally their ETR is zero. Germany has adopted the IIR, but the Caymans have not adopted any GloBE rule. So the ultimate parent entity in Germany has no other low tax subsidiaries. It's only the Cayman one. So how will the application happen? IIR applies, income inclusion rule, meaning the income of the Cayman Island, the tax of pertaining to the Cayman Island subsidiary will need to be borne by the parent company in Germany. So Germany imposes a top-up tax of 15% into 10 million euros, which is the income in Cayman Island, right? GloBE income in Cayman Island. The amount of tax becomes how much? 1.5 million euros, right?
Yeah.
UTPR is not needed. Why? Because the income inclusion rule captures all of the top of tax. So we don't need to resort to the second, backup rule of UTPR. Income
Because
inclusion
there's no
rule,
subsidiary companies as such. There's
yeah,
only one.
only
Yeah.
one. Yes. So variation. So there's another scenario also provided. Let's say if parent company, let's say if parent company were in a non-adopting jurisdiction instead of Germany. Yeah. For example, USA, if it
Mm-hmm.
hadn't adopted yet.
Mm-hmm.
Then, but the subsidiary co in the Caymans had a sister company in the
Mm.
UK.
Oh. Uh-huh.
So we are assuming that where is the parent company located?
In
In USA,
USA.
which has not
And
adopted
they're
the
not
GloBE rules.
eligible for the GloBE rule. Okay.
Yeah. So interest subsidiary is also in a jurisdiction where there is,
In reality, US is not
we
agreed to
have
the
to
GloBE rule.
that I have to confirm actually.
Okay, all right. No, no.
US is a very strange jurisdiction because they sometimes defy everything. They did not adopt IFRS. They have their own model tax convention, right? They don't follow OECD. usually.
Yeah, by default, they are dominance of the world. So,
Uh, exactly. So, but anyways, the US, let's say they did not adopt, so the parent company was not in a globe jurisdiction, right? But and
mhm.
subsidiary had no tax. But Subco in the Cayman had a sister company in the UK. So, but UK has adopted a globe rules.
Mm.
Then the UK would deny deductions to the sister company to collect the 1.5 million top up tax. So, if there are any, uh, deductions, uh, we have to think about what kind of deductions are we talking about. And it's only a sister company. So probably this refers to um, intercompany transactions probably that the UK would deny the deductions to the sister company to collect the 1.5 million top up tax. So if there are any such transaction
Between
or
parties, okay.
if there are any intercompany transactions between UK and that subco, then UK as far as the double tax arrangements go, UK would deny any deduction. So any expenses that arise, UK will UK company will be subjected. So there will be an extra 1.5 million euro worth of taxes erupting in the UK company. So if there are any purchases made by the UK company from the Cayman Island, the UK framework will deny the deductions. Do you understand
Yeah,
what
got.
are, so the
And
profit
if
will
that is the
increase.
if, and just to make sure that if they're denying and that is the only income which is being generated as intercompany transactions, no other income
Yeah,
is being
yeah, yeah.
generated by the sister company. I mean,
Correct.
by the Cayman Island.
But yeah, exactly. So, but in order for this to be successful, there will need to be intercompany transaction. If there are no intercompany transaction, then it will become a bit, it will be strange. It will be difficult, right?
Hmm.
So that's why sometimes a combination of rules may be applied even. Okay. So we will revert back. We'll take a break now, and inshallah, after some time, we will revert back. Okay.
Sure. All right.
Okay. Thank you very much.
Thank you.